Hello guys, it's been a while. I apologize for the delay, and it was on genuine grounds that I was not able to take it up. And let us resume because we finished transfer pricing, and I thought that I'll take up the next topic. Though this might not be useful for the May students because the exams are already over. However, it is still not late, and the November students will generally stand to gain out of these classes. So now, all said and done, the next topic that I have decided to take up is assessment procedure. Now, this is procedure of assessment or assessment procedure or whatever you call it. Now, this topic, if you see the trend that the institute has been showing over the past examinations, is generally questioned between 8 to 10 marks, including the MCQs that you are bound to get from these topics. Now, this topic is generally not the most preferred topic because of the hefty amount of theoretical portions that are involved and cumbersome amount of due dates or probably the deadlines that are involved in this topic. So I decided to take this topic up and probably give a more story based approach, or if not a story based approach, at least a more practical approach so that we will be able to connect the topic better. Now, can I ignore this topic for the purpose of examination? Definitely no, because it is mandatorily tested in every examination. And those who are already into the articleship of their tax firms or who are doing the articleship in tax firms, they'll be able to appreciate the topic better because they would have seen the practical side of things here. Unlike topics like PGBP capital gains, where you will be able to associate provisions with problems, here the problem association is more towards the theoretical concepts. So it will be a bit taxing and bit heavy, but at the same time, it is an interesting topic. So let us jump into the topic and understand. Now, all said and done, is the word assessment procedure defined in the Income Tax Act? There is no definition. There is no definition as such. No definition for the term assessment procedure. Or you will not even find this term assessment procedure anywhere in the Income Tax Act. Where in the Income Tax Act there is no definition. So, what is this assessment procedure? Is it only for the purpose of income tax? No, even indirect tax, just GST or customs, have what is called as this assessment procedure. Why go to the extent of tax laws? Even for that matter, the entire premise of this chartered accountancy course is based on the assessment procedure. So, what is the assessment procedure for chartered accountancy course? You prepare, you go into the examination, you write the examination. That is where the role of a student ends. Then the role of the institute begins. So they evaluate and then they come up with additional conditions. Again, the role of the students begin. You have to do your ITT, you have to do your MCS. Then once again it goes back to the institute. They conduct the examination again. You clear the examination and then you are declared a member. Now, this procedure of assessment is to see whether you are worthy enough to become a chartered accountant, right? So, the assessment happens at every stage to see whether you are worthy chartered accountant. Likewise, in income tax point of view, the assessment happens to see if the assessee has rightfully determined the income, rightfully determined taxable income. And it is also to see whether taxes are paid. Okay, and further in the assessment procedure, the department also checks whether you have complied with the provisions of law whenever you claim a reduction of any expenditure or exemption of any income. So, going by this thumb rule, we can come to a consensus that the assessment procedure by itself is broken down into two aspects. So, aspect number one is assessee's role. Aspect number two is department's role. So, what is this assessee's role and what is this department's role? So, I am an assessee. So, what is the first step in this entire process of assessment? I have to go and apply for a PAN. Apply for a PAN. And now that PAN and Aadhaar are interchangeable, I should also link it with the Aadhaar. Okay, so I have to go ahead and apply for the PAN. And second step is to determine taxable income. So this is where the memo of tax or probably the tax computation, tax workings are done, and you determine what is the tax liability for the period concerned, and then payment of taxes and applicable interests. Sometimes you may have to pay interest as well because of delay in remittance of tax. So this could be in the form of interest under section 234C, or when the return filing is already done, interest under section 234B. We'll not rush to 234BC right now, but just understand that assessee's role is also inclusive of determining the taxable income and payment of taxes. So the assessee has done all these three steps. Now, how will the department know that you have done these three? They will not go and search all the challans. They will not go and they will not come to you and ask for the taxable computation. So they need some sort of communication that you have complied with these three. So the fourth step, where the assessee has to go ahead and file income tax return. So this is the role of assessee in an assessment procedure under the Income Tax Act. So for the procedure of assessment to get triggered, he has to apply for a PAN, he has to determine his taxable income, he has to pay taxes along with the interest if any, and then he has to go ahead and file the return of income. Now he has filed the return of income. Then the role now shifts. It now shifts to the department. From assessee, the responsibility now shifts to the department. What will the department do? They will initiate assessment proceedings. So they might send a notice telling that we have picked your case for the purpose of assessment. We would like to know what are all the details you have considered for the purpose of determining income. What are all the details you have considered for the purpose of determining the rate of taxes, and what are all the details you have considered for the purpose of arriving at the tax payable, and please share the details of taxes paid. So they may go ahead and ask these questions by way of initiating assessment proceedings. And we all know that there is something called as centralized processing center in Bangalore. Okay, so every time your return is e-filed, those who have worked in a tax firm, they will be able to understand. And once you verify the return, it goes to CPC Bangalore, where an intimation is sent, to the assessee. Erstwhile, the intimations were not mandatory, but now with the insertion of section 270A penalties, intimation is given in almost all cases because the penalty trigger is based on intimation. So CPC Bangalore will send out an intimation either accepting your return or specifying changes. They can either accept or specify changes. The changes necessarily need not be additions. For example, you file a return with a refund. They might send an intimation telling that, boss, you have claimed a refund of 10,000. However, you are also eligible for interest at the rate of 0.5% per month. So you are eligible for interest of 1,500. So the total refund is not 10,000, it is 11,500. So this is a news that is going to make the assessee happy. This also comes from the department. Okay, so the CPC Bangalore is a centralized processing center which may send up what is called as an intimation. So what can the department do? They can initiate assessment proceedings, or if there are certain apparent issues which can be found without human intervention, that will be thrown out by means of an intimation. For example, you have done mistakes that are apparent from the return that you have filed, then you get a negative intimation. Or as I had told you before, you have filed a return with refund and you have not included interest. This will come as a positive intimation, assessee favoring intimation. Now, apart from this, the department can call for information based on whatever return you have filed, and then finally they can pass assessment orders. Pass assessment orders. Okay. And not only that, wherever they feel that after passing the assessment order, they are of the view that some income has not been offered to tax. They have passed the assessment order. After that, within a specified time limit, which we will study in the due course, they have found out that you have not offered some income to tax. They would go ahead and start what is called as reassessment or reopening of assessment. Reassessment or reopening of assessment. Sometimes the commissioner of income tax or the principal commissioner of income tax or the chief commissioner, then they find out that there are some mistakes that are apparent from the order passed by the assessing officer, then they can go ahead and revise. So this is also part of the assessment procedure. However, it is called as revision. So the department's role is also extended to revision. This revision can be initiated suo motu by the department if it is prejudicial to the interest of the department. If it is prejudicial to the interest of the assessee, generally the assessee will ask, or the department may also do it suo motu. Sir, this is too much to process, sir. So don't worry, we have not even gotten into the subject. This is a bird's eye view of what is assessment procedure. So what can the department do? What can the assessee do? Now, department has passed an order. So this point, they have passed an assessment order, and you feel that something is a blatant mistake. You have paid tax of 10 crores, but they have considered only 4 crores. So this is a blatant error, mistake. So if there is a mistake that is apparent on record, assessee's role will once again trigger, and he will file a rectification petition. So he can file a rectification petition. And for this rectification petition, department can file a rectification order. Not file, the rectification order will be issued by the department. So this is the entire ambit of assessment procedure. So the assessee goes ahead, gets a PAN, finds the income, goes ahead and pays taxes. After that, he files the return of income. Department processes the return. If they keep quiet, it is understood that assessee has done his job perfectly well. In case they give an intimation, it means that there are mistakes apparent on record. Otherwise, you may get a notice telling that, boss, we have picked your case for assessment. So if this notice is received, they will call for information which you will have to go ahead and submit. Sir, this faceless, don't jump to faceless yet. We will come there. In the due course, we will come to the faceless portion. And then the assessment orders are passed based on whatever information is submitted by the assessee to the assessing officer. Then, wherever the assessing officer has received the information and is satisfied, he passes the assessment order. And if he feels that after passing the assessment order, he has identified some income which is not offered to tax, he can reopen the assessment, or what is called as reassessment proceedings can be triggered by the assessing officer, and so on and so forth. So this is the ambit of assessment procedure. So we are here to study what? We are here to study what is the role of assessee, what is the role of department in detail. So the intention is to find out what is assessee's role in this procedure, what is the department's role in this procedure. Now, this portion, determination of taxable income, is covered under your 5 heads of income. So we will not be discussing on that right now. Application of PAN, this is one part we will be determining right now. We will be going through right now. This is one part which we will be going through right now. Payment of tax is dependent upon determination of taxable income. So these 2 points we already have studied in our intermediate to some extent, and also in final you would have studied to some extent, or probably if you're doing your articleship in a tax-based firm, you will generally know what is this second portion of payment of taxes and applicable interest. So those are not assessment procedure topic for us to discuss. So the main topic from an assessee's point of view will be filing of income tax return. So our primary focus from the assessee's role will be with respect to filing of income tax return. So with that said and done, let us straight away jump into the first section which is relevant to us. Section 139.1, which is what? Return of income, or you can refer to it as regular returns. So does that mean there is an irregular return, sir? Yes, there are irregular returns, which we also call it as belated or late returns. So let us not go there. Let us first understand what is right before we go to what is wrong. So this is going to be the first section that we will be going through, section 139.1. Now, what is this section trying to tell us? It is first trying to tell who are liable to file the return of income. This is the first question this particular section is trying to address. This question all of us will always have. Forget the fact that we already know assessment procedure. You have a grandfather or probably an uncle who are not from commerce background. The first question they come and ask you when you tell them that you're a chartered accountant or probably you're going through the course of CA, as to whether they are required to file the return or not. They'll come and tell you, I have only pension income, my income is 4,50,000, should I file return of income or not? So this is how the questions are generally framed around this assessee's role. What is the first question? Who are liable to file the return of income? Okay. So what is this section trying to address? The first point that the section is trying to address is that there are certain mandatory cases. There are certain mandatory cases. So the section is trying to tell that a certain category of persons are supposed to always file the return of income. So who are they? First one, companies. Second one, firms including LLPs. Now, companies and partnership firms, including limited liability partnerships, are supposed to file the return of income mandatorily. Now, the question might be, sir, suppose they have made losses for the year, they have to file return of income. Sir, they have incorporated this year, but they have not commenced business, still they have to file the return of income. Sir, the partnership deed was signed, the partnership is formed, but nothing has happened after that. Still, you have to file the return of income. So, the mandate provision says that you have to file despite whatever be the scenario. Despite whatever be the scenario, these two assessees will always have to file the return of income. So, let us take an example from the handouts that are given. Firm or company incorporated during 30th of March 2022, and the question is whether this firm is required or the company is required to file the return of income. So what are they trying to tell? Firm or company is incorporated on 30th of March 2022. So only one day it has stayed in existence after it's being formed, and nothing has happened. No business was done, nothing is done. Whether they are required to file the return of income? Yes, they are required to file the return of income. Okay, they are required to file the return of income. Now, loss, yes, they are supposed to file the return of income. We'll come to that. There is one more section called 139.3 which talks about loss return. We'll come to that and then we will discuss it in detail. But there is a mandate to file return of income even if there is a loss made during the year. So these two assessees are mandatorily required to file the return of income. Now, there is a third category person and we will refer to them as other cases for ease of understanding. So these other cases, what all will come here? Individual, HUF, AOP, BOI, AJP. So these guys are not covered in company, they are not covered under companies or they are not covered under firms including LLP. So now we are going to deal with these cases. Okay, so these cases, what is the peculiarity as compared to companies and firms? For these cases, we have what is called as a slab rate of taxation. So up to 2.5 lakhs not taxable, up to 3 lakhs not taxable, up to 5 lakhs not taxable, etc. are the rates that are given for these type of assessees, right? So the definition of mandatory return for these type of assessees have been slightly modified. So, what is the definition? If the gross total income of these assessees is greater than basic exemption, then they will have to file the return of income. So, what are they trying to tell? Gross total income of these assessees. These assessees meaning individual, HUF, AOP, BOI, AJP. If the gross total income of these assessees before, sorry, these assessees is greater than basic exemption, then they are supposed to file the return of income. Now, what happened? There was one person, Mr. X. What this Mr. X did was he had interest income of 80,000. So let us see this scenario. Mr. X had interest income of rupees 80,000 and he sold property. He sold property for rupees 30 lakhs. He sold a property for rupees 30 lakhs and invested in 54 EC bonds within 6 months. So we all know capital gains topic. So what has Mr. X done? He has sold a property, made capital gains, or he sold a property, consideration is 30 lakhs, and let us assume that gains are also 30 lakhs. Okay, and he has invested them in 54 EC bonds. Limit for 54 EC is 50 lakhs and time limit is 6 months. He is complied with the provisions of the section. Now what has happened? His total income. What is his total income? Total income is equal to 80,000, which is your interest income, plus 30 lakhs, which is your capital gains, minus 30 lakhs, which is your 54 EC. Therefore, your total income is 80,000. Mr. X, let us assume, is not a senior citizen or super senior citizen. So, what is the tax slab rate for which he will be applicable? 2,50,000. Up to 2,50,000, he is not required to pay any tax. He is not required to pay any tax. Okay. So here, what is his total income? 80,000. Okay. Because of this, what people started doing, what Mr. X did was, he actually did not invest in 54 EC bonds, but he simply said that I have invested in 54 EC bonds. He simply said that I have invested in 54 EC bonds, and which means what? 80,000 is going to be the taxable income here. Now what has happened? Department is of the view that this fellow has had income of only 80,000, so no tax, but which is not the case. What is the case here? His income is 30 lakhs 80,000. So people started playing around with tax filing on this regard. So once you don't file, department will not know whether this 30 lakhs worth of transaction which you have made, this 30 lakhs worth of transaction which you have made is genuine or not. They will not know whether it is a genuine transaction or not. So to ensure that you do not misuse this provision, our finance minister, Mr. Arun Jaitley, came out with an amendment. He told, boss, wait, we will not only have gross total income, we will have gross total income before exemption under section 54, 54B, 54D, 54 EC, 54F, 54G, 54GA and 54GB. So what did he tell? Gross total income definition and all we will not live with. We are now going to modify the definition. What is it? Gross total income should be gross total income before claiming the exemption under these sections. So now what will happen? Mr. X will have to file the return of income. He cannot take the shelter of 54 EC. Now when he files it and if he puts some number in 54 EC, department will easily catch hold of him through the assessment procedure initiation. That is why they made this amendment. So what is the third condition? Gross total income before 54, 54B, 54D, 54EC, 54F, 54G, GA, GB. These are sections you will study under capital gains topic as exemptions. Your gross total income, if it exceeds the basic exemption, then you were mandated to file the return of income. Some of you might have a question, sir. All this is fine. What about chapter 6A deduction, sir? I can also play around with that, right? Yes, you're right. That is why I have used the term gross total income. What is gross total income? Gross total income is equal to gross total income is equal to total income plus 6A deductions. So the department wanted to ensure nobody played the fool with any deduction. So they wanted to know, if you have claimed the deduction, please ensure that you have claimed it and disclosed it as well. So if I have claimed deduction under chapter 6A, my income is 3 lakhs. Okay, my total income, gross total income is 3 lakhs. Chapter 6A deduction under 80C. For example, I have claimed 1 lakh rupees. Now, am I liable to pay any tax? No, because no tax liability arises if my income is less than 2,50,000. My income here is how much? Net taxable income or taxable income is going to be 2 lakhs. So I am not liable to pay any tax. However, I am liable to file return of income. Why? Because gross total income, which is before 6A reduction, is more than 2,50,000, my basic exemption. Therefore, I am liable to file the return of income. Is it clear? So I am liable to file the return of income. Now, by ensuring that the included 6A deductions and 54EC etc. Sorry, capital gains exemptions under section 54, they made sure that no one claimed bogus deductions or bogus exemptions. Also, they have included the provisions of 10, 10A, 10B, 10BA, 10AA, etc. However, these provisions are no longer active except for 10AA. So we don't have to be bothered about remembering these provisions. Theoretically, they are no longer active but for 10AA. So there is no mandate for us to remember these provisions. And also understand, when they talk about 6A reductions, they are not bothered about 80D, 80C or 80G, etc. because those are all smaller deductions that you claim. You cannot claim a huge amount. And for claiming those deductions, the assessee has to ensure an investment is being made, an amount is being spent by the assessee. The department is more focused on the income based deductions, that is 80I series. So if you see 80IA, IB, IA, sorry, IBA, 80 IAC, so these are the sections that the department is more focused upon. Now, please understand, these deductions, exemptions for the purpose of filing return are applicable only for these assessees. Okay, so 80 IAC is an eligible startup deduction, is applicable for companies. So we are not even bothered. Company, whether it claims 80 IAC or not, it has to file the return. However, 80 IBA, for example, development of housing units. So that an individual promoter can also claim. Yes. So in that case, we'll have to see that he has filed the return of income. If he has not filed the return of income, then he will not be eligible for claiming that deduction. So the very purpose is to ensure that those deductions are rightfully claimed. So how do we check it as rightfully claimed? He has to disclose it in the return of income, and once he discloses it, there will be a checking that will be done by the department to ensure that it is rightfully done. Clear? So the 6A reductions and the 54 sections are brought in to ensure that no bogus claims are made by the assessee, and that can be checked only if the assessee files a return of income. Therefore, it is mandated that these assessees file the return of income. Is it clear? Yes? Now, what we'll do is we'll take up a couple of examples. Just look into the material that is shared with you. First case. Mr. A salaried assessee, has salary income of 2,90,000. So Mr. A salary 2,90,000 before claiming standard deduction of 50,000. So, is he eligible for standard deduction? He is eligible for standard deduction, and the amount of standard deduction is 50,000. Therefore, his gross total income is 2,40,000. His gross total income is what? 2,40,000. In this case, is he liable to pay tax? We will answer both the questions. Liable to pay tax. Liable to pay tax is nil. There is no liability to pay tax because his total income is less than 2,50,000. Now, liable to file return. Liable to file return. What are we going to tell? No. Why? Because gross total income before 6A reductions, before, sorry, not 6A reductions, before exemptions is less than basic exemption. Therefore, there is no mandate for Mr. A to file the return of income. Fine. Now, let's take the second question. Example 2. Mr. Rocky, age 30, has capital gains from sale of property in Bengaluru, aggregating to rupees 3 crores, which he invested in another house property and claimed exemption under section 54. He had interest income of rupees 1.8 lakhs apart from the same. Is he liable to file his return of income? So, what does Mr. Rocky have? Mr. Rocky has capital gains of 30 lakhs and interest. What is the interest that he has? 1.8 lakhs. So, 1 lakh 80,000 less 54 exemption. He has invested the entire 30 lakhs, so he need not have it. So what is the gross taxable income? Gross taxable income is 1,80,000, but 139(1) defines gross taxable income to be gross taxable income before the exemptions under section 54. Therefore, let us answer this question. Liable to pay tax? No, or nil. Liable to file return? Yes. Why? Gross total income before exemption under section 54 is more than basic exemption. Clear? So, remember the basic cardinal rule. Your gross total income, which is what? Total income before Chapter 6A reductions or before the 10AA series and before exemptions under Section 54 should be greater than your basic exemptions. When I tell Section 54, it means 54, 54B, D, G, GA, GB, EC, F, everything. Okay. Now, come to the next example. Mrs. Kamala, age 83. So, which means what? She's a super senior citizen. So, Mrs. Kamala is a super senior citizen. So, what is her pension? Pension is 1,50,000. Now, interest income is 1,80,000. And house property income computed. Let us assume it to be computed. There are no deductions, exemptions now. Let us assume the final computed numbers are given. So is how much? So the total income is 4,30,000. So liability to pay tax. Liable to pay tax is nil. Why? Because super senior citizen up to 5 lakhs they do not have to pay any tax. Likewise, to file return again is no, because GTI less than basic exemption before exemptions. So this is what we have to understand with these problems. So next one, Mr. Sarvesh has salary income of rupees 5 lakhs and house property loss of rupees 1 lakh and he also has interest income of rupees 2 lakhs. He claimed deduction under section 80C for 1,50,000 and section 80D for 50,000. Comment on his tax liability. So, salary income. What is his salary income? Salary income is 5 lakhs, and then interest income is 2 lakhs, and loss under house property is 1 lakh, so that will be a reduction. So he has gross total income of 6 lakhs and chapter 6A deductions of 2 lakhs. 1 lakh 50 plus 52 lakhs. Therefore, his taxable income, so taxable income is 4 lakhs. Liable to pay tax, nil. Why? Because he will be eligible for a rebate. He will be eligible for rebate up to the extent of rupees 5 lakhs of total income. So there is no question of tax liability arising here. Now the next point is to file return. Yes. Why? Because gross total income is greater than 2,50,000. That is his basic exemption. So have we understood? So we have seen three cases of mandatory return filing. What are they? Companies will have to mandatorily file return of income. Two, partnership firms including LLP have to file mandatory return of income. Three, other assessees, individual HUF, AOP, BOI, HAP, who have gross total income, that is income before Chapter 6A deductions and before exemptions under Section 54, 54B, 54D, 54EC, 54F, 54G, GA, GB, greater than basic exemption, then they will be liable to what is called as file return of income mandatorily. So this is the starting provision with respect to provisions of section 139(1). So who is required to file the return of income? Sir, are there any additional persons over and above these persons who are required to file a return of income? Yes, there are. But before that, let me reiterate, 6A deductions are specifically excluded and 54 series are specifically excluded to ensure that there is genuineness in the claim that is made by the assessee. They want to ensure that the claims made by the assessee are factually correct and are not bogus claims. Okay, now let us see what else has to be done. Let us go to the next one. Sorry. So the next provision, there are certain other cases where the return of income has to be mandatorily filed. Now, what happened? Nirmala Sitharaman, Nirmala Sitharaman, RFM, sorry, I have to write that. Nirmala Sitharaman, RFM, had brought in certain additions to the cases that are mandatorily required to file the return of income. So the first case that she included was deposit in one or more current account more than rupees 1 crore. So the first condition she brought in was an assessee who goes ahead and deposits more than rupees 1 crore in aggregate shall be mandatorily required to file the return of income. Will companies be covered here? No. Will firms be covered here? No. Why? Because they are already mandated. We are talking about individuals, HUFs, AOPs, BOIs, etc. Suppose they go ahead and deposit in more than one current account or in one current account during the year for an aggregate of rupees 1 crore, then they are mandated to file the return of income. Now, why is this point brought in? Suppose the person is not covered in point number 3. What is point number 3? Gross total income before 6A reductions, before exemptions is greater than basic exemption. Suppose I am not covered there. But however, I make deposits of 1.5 crores. Then the department wants to know where is this money coming from? What is this money? Why is such a low income being declared? That is why they wanted to bring in these persons within the ambit of mandatory return filing. They wanted to find out if you are having the power to deposit 1.5 crores or more than 1 crore a year by showing income taxable at less than your basic exemption limit. There is something that we want to check, so please disclose. So they wanted the assessees to mandatorily file the return of income even though they would not be covered under the gross total income category. Now, then, second case, don't worry, we'll be seeing examples that will get you some clarity into this. Second case, incurs foreign travel expenditure. Foreign travel expenditure more than rupees 2 lakhs for himself or for any other person. So why himself? Himself or herself. So there is no gender ambiguity here. Just by word of mouth, I have specified himself. It could also include herself. So there is no discrimination that is brought in. Fine. So the second point is that Nirmala Sitaraman told, you claim that you don't have taxable income. Fine. I don't have a problem with that. But how are you able to go to a foreign country and spend lakhs of rupees when you don't have taxable income? I want you to first disclose your taxable income. And when you disclose, you're telling me you don't have money, so no tax, but you're able to go abroad and spend. So something is not right. So if you have travel expenditure greater than rupees 2 lakhs, please disclose your return of income, even though gross total income will be lower than the basic exemption limit. Fine. Then she didn't stop there. She brought in one more condition. Electricity bill of more than rupees 1 lakh. You don't have income. The total income per annum itself is less than 2.5 lakhs, and you want to spend more than 1 lakh for electricity bill, which means that something is fishy. Either you would have filled up the entire house with AC, because people who get 8,000, 7,000 worth of electricity bill will definitely have multiple air conditioners. Otherwise, it is not possible to get such a bill. Okay, and if such a bill is generated, then you are having some source of income to repay that. Right? You are not going to give more than half of your income towards electricity bill. So something is not right, something is fishy. The life seems to be extremely luxurious. We want to find out what is the source of income. So please file the return of income if your electricity expenditure is more than 1 lakh rupees. Now, those who have worked in tax firms or those who have had taxation as their articleship standpoint, they will know that when you file with the latest utilities, there will be a drop down where you will have certain other conditions also. Apart from the threshold condition, there will be electricity condition separately specified. You will have separate conditions specified for travel expenditure, reason for filing, or something will be the terminology given where they will specify what is the basis for filing the return of income. Right? So these are the three conditions. Suppose I don't get covered under the third subclause, which talks about the gross total income, I will still be mandated to file the return of income if I am covered in any of these three. Any of these three. Okay, fine. Let us take an example. You can refer to the material. Mr. A deposits rupees 45 lakhs in current account with Canara Bank and 15 lakhs with current account with SBI and rupees 55 lakhs with current account in Axis Bank. His total income before 6A reductions and exemptions aggregate to rupees 1.9 lakhs. Whether return filing is mandatory. Now, what is the aggregate deposits? The deposits made is 45 lakhs plus 15 lakhs, which is 60 lakhs plus 55 lakhs. Therefore, 115 lakhs is the total deposits made. He has made deposits of 115 lakhs. What is his total income? His total income is 1.9 lakhs. His total income before 6A reductions, before 54 series is 1.9 lakhs. Will he be covered under the third limb? He won't be covered. he will still be exempted from filing return, but he will get caught here. Here he will be caught and he will be asked to file the return of income because his aggregate is more than 115 lakhs, which answers our next question. Sir, should 1 crore be deposited in each of the current accounts, or all current accounts put together? Should it be one more than 1 crore? The answer is there in this problem. Even if you are able to put 1 crore in all the bank accounts put together during the year, you will be mandated to file the return of income. So what am I trying to tell? This more than 1 crore need not be in one current account itself. It can be split over n number of current accounts. You can put it over n number of current accounts. 20 lakhs னு போட்டு 5 current accountல போட்டாலும் you will still be mandated to file the return of income. Okay, more than 1 crore, so slightly more than that. So, deposits in one or more current account where the value of deposit exceeds rupees 1 crore, then you will be mandated to file the return of income even though your gross total income is lower than the basic exemption. Fine. Now, the next example. Mr. B went on a foreign travel spending rupees 3 lakhs for this trip. His income was rupees 1.5 lakhs. So, foreign travel. Foreign travel cost. So, foreign travel spending. So, what is the foreign travel spending? Is equal to 3 lakhs. What is the threshold given? What is the threshold that is given here? Foreign travel threshold is 2 lakhs. You can spend only up to 2 lakhs, but he has ended up spending 3 lakhs. So, despite the fact that his total income is 1.5 lakhs, he will still be mandated. He will still be mandated to file the return of income. Is it clear? He will still be mandated to file the return of income. So, whether return filing is mandatory? Yes, return filing is mandatory. Now, go to the next example. Mr. C and Mrs. C went on a trip to France and spent rupees 1.8 lakhs. So, Mr. C spent 1.8 lakhs. Mrs. C spent 1.4 lakhs. So, have they both spent more than 2 lakhs or less than 2 lakhs? They have spent less than 2 lakhs. They have not spent more than 2 lakhs. They have spent less than 2 lakhs. Their total incomes were 1.5 lakhs each. Assume that there is not going to be any sort of 6A reductions, exemptions, etc. So, are they mandated to file the return of income? No. The spending has to be more than 2 lakhs. The spending has to be more than 2 lakhs. Here the spending is less than 2 lakhs. So the mandate to file the return of income has not been triggered. So they are not required to mandatorily file the return of income. Is it clear? So the specific point was brought up so that you would be able to understand that there are still ways to avoid filing a return of income if you are able to rightfully plan it. Okay. Now, what happens? One person comes to the department and tells that, sir, I am an ardent devotee of Balaji. So I had gone to Pittsburgh to the temple of Lord Balaji, and it was a pilgrimage. I was on fast for 41 days. So there is no necessity for you to consider it as foreign travel. It is not a foreign travel, it is a pilgrimage. I have photos, videos to prove that I have gone only there. I have no relatives. I can show you the entire itinerary. He's telling everything. Why is he doing this? Because department has sent a notice telling that, boss, you have not filed your return. Your travel expenditure is 5 lakhs. Department is telling your travel expenditure is 5 lakhs, but you have not filed the return of income. He is coming and crying, telling that I am a devotee of Balaji. I have gone there solely for the religious purpose. Department is least bothered. You go for temple, you go to mosque, you go to church, we are not bothered. You go there for honeymoon, we are not bothered. You go there for property settlement, we are not bothered. You travel, you spend, please file the return. That's all. So the purpose of visit will not have any impact on whether return has to be filed or not. It has to be filed if your expenditure exceeds the threshold of 2 lakhs. So purpose of visit is of no concern. Clear? Now, So the next example, I have not given any example for the electricity bill. So it is self-explanatory because the purpose is to ensure that if you are living a luxurious life, you are bound to have some source of income which you are not disclosing. That is why they ask you to file the return of income and they will take it forward from there. So if you spend more than 1 lakhs for electricity bill, then you are bound to file the return of income, irrespective of the fact that your gross total income is lower than the basic threshold limit. Some of you might ask a question, sir, my brother is located abroad and my parents are not earning. He is the sole earning member and I also am an article. So I am not earning much. So the only source of income that we get is the amount transferred by my brother who is located abroad. Now, for my parents' anniversary, brother has arranged for a foreign trip. He is arranged for a foreign trip and he has borne the expenses fully. Will he be required? No, no, no. Don't go to that extent. Where the spending has been done by a person in India, resident in India, then only this question of tax return filing comes into play. A non-resident situated outside India who is spending for his parents situated in India for travel outside India and all is too complex a scenario which will not come within the ambit of return filing. So you can be rest assured that no return filing mandate will be considered for that scenario. Is it clear? So the person who is a resident in India who spends for his own travel or for somebody else's travel and such spending is more than the amount of 2 lakhs and his income, his taxable income is lower than the basic threshold limit, then he will be mandated to file. Fine? Is it clear? Suppose if it is going to be a friend who's sponsoring for your honeymoon and he's spending, let us say, around 7 lakhs and he has only shown an income of 1.9 lakhs and he's not filed the return of income. In this case, he will be mandated to file the return of income. He has not traveled, he has sponsored for you, still he will be mandated to file the return of income. Is it clear? Just to see where he's getting the funds from and why he's trying to sponsor your trip. In no offense meant, just to find out where the income is from. Why he sponsored is not a tax question, that is more of a personal question which we will try to address later. So this is the crux. So what have we seen today so far? We have understood the provisions of 139.1, section 139.1 to a limited extent. So what have we understood? What are all the cases where return filing is mandatory? Case number 1, companies mandatorily are required to file the return of income. Case number 2, partnership firms including LLPs are mandatorily required to file the return of income. Case number 3, other assessees, individual HUF, AOP, BOI, AJP, who have gross total incomes before Chapter 6A reductions and before exemptions under Section 54, 54B, 54D, 54EC, 54F, 54G, 54GA, 54GB, more than the basic exemption threshold, then they will be bound to file the return of income. However, certain amendments were made where they brought in certain additional categories of people who are mandated to file the return of income. Who are these additional categories of people? Who have basic threshold not met for their total income, however, have had foreign travel for an amount exceeding rupees 2 lakhs. That is, their gross total income is lower than basic exemption limit, but they've had a travel expenditure of more than rupees 2 lakhs. Then they shall be bound to file the return of income mandatorily. Case number 2. Deposit has been made in one or more current accounts and the aggregate of such deposit exceeds rupees 1 crore. It is all about exceed. It is not is equal to and more. It is exceed. Exceed rupees 2 lakhs, exceed rupees 1 crore. Then he shall be bound to file the return of income irrespective of the fact that his gross total income before exemptions and deductions are lower than the basic threshold limit. Now, the next point that I want you to know is with respect to the third special category, which is with respect to the electricity bill, where the TNEV bill that they receive or the local electricity bill that they receive is more than rupees 1 lakh per annum. Then they are again asked to file the return of income irrespective of the fact that their total income is lower than the basic threshold limit. Okay, so is this clear? So this is the starting point and we have seen some rationale behind these provisions. For example, deductions and exemptions to check whether they are genuine or whether they are bogus. And the deductions that they focus upon are income based deductions and not with respect to the ATC, ATD, because those are all spending based deductions. Sir, will they ask the intentions? No, 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 no. You're not going to write any examination for the purpose of legal side. You are doing a chartered accountancy course. It is just for you to understand the intention of the law so that you will be able to understand it better when you study. Now, likewise, when we also saw one example where the spending for the travel expenditure, if it is being equally apportioned between two assessees and the amount is not exceeding rupees 2 lakhs, then the mandate of the return filing will not apply. Okay, and we also saw that with respect to any exemptions other than 54, if those exemptions are claimed or not claimed and the income is more than basic threshold, but after claiming those exemptions, if it falls short, there is no mandate to file return of income. For example, house property income is 3 lakhs. Okay, and then interest is 1,50,000. You reduce this interest. You cannot tell return filing is mandatory because house property is 3 lakhs. No, house property is not 3 lakhs, it is 1,50,000. The only deductions which are restricted are 6A deductions. The only exemptions that are restricted are 54 to 54 GB, and then 10AA, 10A, 10B are also restricted. Okay, so these are the basic introductory provisions with respect to assessment procedure, and the topic that we have covered today is who are required to file the return of income. Now, what is the way ahead? What is the way forward? We still have few more categories of persons who are still required to file the return of income. Then we are to go ahead and identify what are all the conditions or what are all the due dates for filing a return of income, and then we will see some waivers that have been given. Some waivers have been given from filing a return of income. Certain categories of people are not required to file the return of income. Who are they? So we will see that those categories are apart from the exceptions from here. So for example, you are not covered in these three cases. You are not covered in these three cases, and your basic threshold is lower than 2,50,000. You will not be taxed. We already know that. We are talking about certain exceptional cases over and above this. So those we will be separately seen. Okay. So we'll catch up in the next class and we'll take it forward. Thank you.